Ya, Assalamualaikum warahmatullahi wabarakatuh. We are from Group 5, consisting of me, Nadhratul Hikmah, Ananda Putri Nabila, and Jeremia Aprilianto Maldin will present about audit of inventory and warehousing cycle. This is the learning objective of this chapter. Next, Jer. Okay, this is the learning objective of this chapter. For the first and second learning objective will be explained by myself. Next. Learning Objective 1. Describe the business function and the related documents and record in the inventory and warehousing cycle. Next. The inventory and warehousing cycle can be thought of as comprising two separate but closely related systems. First one involving the physical flow of goods. About the movement of inventory or the movement of raw material from the beginning to be processes to become semi-finished goods or part of the working process to become inventory or ready to sell goods. The next one, the related costs. About the costs associated with the movement of goods, the example of incoming inventory, what we are talking about is what price we have to spend to get finished goods, starting from raw materials, paying overhead, paying personal costs, and so on, until there is a final item that we will sell. Next. There are 6 functions make up the inventory and warehousing cycle. First one, process purchase order. The inventory and warehousing cycle begins with the acquisition of raw material for production. This section will be handled by stockroom personnel. The second one, receive raw materials, which is also part of the acquisition and payment cycle. Involve the inspection of material received for quality and quantity. This section will be handled by receiving department. The third one, store raw materials. Once received material are normally stored in the stockroom. When another department needs material for production, personnel submit a properly approved materials requisition, work order, or similar document or electronic notice that indicates the type and the quantity of materials needed. The fourth one, process the goods. Companies determine the finished good items and quantities they will produce based on specific order from customers, sales forecast, predetermined finished good inventory level, and economical production runs. This section is handled by the production control department using an adequate cost counting system. The fifth one, store finished good. When the goods are finished, they are placed in a storage room to wait a delivery. And the last one, ship finished good. Shipment of finished good must be authorized by a properly approved shipping document. Next. The inventory recording method used is perpetual inventory master files. Perpetual inventory master file typically include information about the units of inventory acquired, sold, and on hand. With advancement in technologies, separate perpetual record are likely to be kept for raw material, work in process, and finished goods. Next. It is flow of inventory and cost. Two separate systems of inventory as cost are illustrated in this flow. We start reading the flow for an overview of the production stage from the left side to the right side. First, the raw material section. Of course, the company has a beginning inventory. Then the company purchases something that can support the processing of goods like raw materials. And later, the company will get ending inventory. Then direct labor. Determine actual manufacturing direct labor and applied manufacturing direct labor. Then manufacturing overhead. Usually applied overhead is still an estimate that can use a percentage approach or an hourly time approach and other methods. After getting a definite number, it is calculated actually and then the final value will be found. The work in process section, there is a beginning inventory that combines the use of raw materials, direct labor, and overhead. Then we get the ending inventory and then calculate cost of goods manufactured, then finished good, and so on until we get cost of goods sold. Next. Learning objective 2. Explain the 5 part of the audit of the inventory and warehousing cycle. Next. For that, let's see the cycle. Cycle of function in the inventory and warehousing cycle. Next. There are 5 parts of the audit of inventory and warehousing cycle. First one, acquire and record raw material, labor, and overhead. This part of the audit includes the first 3 functions in cycle before. These include processing purchase order, receiving raw materials, and storing raw materials. The auditor obtained an understanding of internal controls over these three functions, and this performed tests of controls and substantive tests of transaction in both the acquisition and payment cycle and the payroll and personnel cycle. The next one, transfer and asset cost. Internal transfer of inventory include the fourth and fifth function in cycle before. Process the good and store finished good. Client account for the activities in the cost counting record, which are independent of other cycles and are tested as part of the audit of the inventory and warehousing cycle. The third one, ship goods and record revenue and cost. Recording shipment and related cost is the last function shown in the cycle before, because it is part of the sales and collection cycle. Auditors obtain an understanding and test internal control over recording shipment as a part of auditing that cycle, including procedure to verify the accuracy of the credits to inventory recorded in perpetual inventory master files. And the fourth one, physically observed inventory. Physical examination is an essential type of evidence used to verify the existence and count of inventory. And the last one, price and compile inventory. Costs used to value inventory must be tested to determine whether the client has correctly followed an inventory method that is both in accordance with accounting standard and consistent with previous years. Audit procedure used to verify these costs are called price tests. In addition, the auditor must perform inventory compilation tests, which are tests to verify whether the physical counts were correctly summarized, the inventory quantities and the price were correctly extended, and the extended inventory correctly put to equal the general ledger inventory value. Okay, that's all for me. Next will be presented by Ananda Putri Nabila.
Okay, number 3, audit of cost accounting. Next. Cost accounting controls, those related to process affecting physical inventory and the tracking of related costs from the time raw material are requisitioned to the completion of the manufactured product and its transfer to storage. It is convenient to divide this control into two broad categories. First, physical control over raw material, work in process, and finished good inventory. And the second, control over the related costs. Next. Test of cost accounting. The auditor is concerned with the four aspects of the cost accounting. First, physical control over inventory. Auditor tests of physical control over raw material, work in process, and finished goods are generally intended to observation and inquiry. Auditors can examine the raw material storage area to determine whether the inventory is protected from the theft and misuse by locks or other security measures, including an inventory custodian. Second, documents and records for transferring inventory. The auditor's primary concern in verifying the transfer of inventory from one location to another are that recorded transfer exists. All actual transfer are recorded, and the quantity description and that of all recorded transfer are accurate. Third, perpetual inventory master file. The reliability of the perpetual inventory master file affects the timing and extent of the auditor physical examination of inventory. When perpetual inventory master file are accurate, auditors can test the physical inventory before the balance sheet date. And the last unit cost records. Accurate cost data for raw materials, direct labor, and manufacturing overhead is essential for fairly stated raw material, work in process, and finished good inventory. To maintain accurate cost data, client must integrate their cost accounting records with the production and other accounting records. Next. Number 4, substantive analytical procedure. Next. Substantive analytical procedure for the inventory and warehousing cycle. Substantive analytical procedure and possible misstatement. Compare gross margin percentage with that of the previous year for the possible misstatement, overstatement, or understatement of inventory and cost of goods sold. Compare inventory turnover, cost of goods sold divided by average inventory with that of previous years. For possible misstatement, obsolete inventory which affects inventory and cost of goods sold, overstatement or understatement of inventory. For the substantive analytical procedure, the number 3, compare unit cost of inventory with those of previous year. for the possible misstatement, overstatement, or understatement of unit costs which affect inventory and cost of goods sold. And number 4, compare extended inventory value with that of previous year. And for possible misstatement in compilation, unit cost, or extension which affect inventory and cost of goods sold. And the last, compare current year manufacturing costs with those of previous year, or variable costs. Variable costs should be adjusted for change in volume. And for the possible misstatement of unit cost of inventory, especially direct labor and manufacturing overhead, all which affect inventory and cost of goods sold. The next will be presented by Jeremia.
The next learning objective is about physical observation of inventory. The first one is about inventory observation requirement. Auditing standards require auditors to satisfy themselves about the effectiveness of the client's methods of counting inventory and the reliance they can place on the client's representation about the quantities and physical condition of the inventories. To meet the requirement, auditor must, the first one, be present at the time the client counts its inventory for determining year-end balance. Second one, observe the client's accounting procedure. The third one is make inquiries of client personnel about their counting procedure. And the last, about make their own independent tests of the physical count. Next, about controls over physical count. The auditor must make sure that they have adequate controls over the client's physical count of inventory. The first one, proper client instruction for the physical count. Second one, supervision by a responsible company personnel. Third one, independent internal verification of the counts by other client personnel. Fourth one, independent reconciliation of the physical counts with perpetual inventory master files. And the last, adequate client control over counts, sheets, or tags used to record inventory counts. Next, audit decision. When the auditor makes the audit decision, there are a few things to note. First one, timing. When the perpetual records are accurate and related controls operate effectively, it may be unnecessary for the client to count all the inventory at year end. When there are no perpetuals and the inventory is material, the client must take a complete physical inventory near the end of the counting period. The second one is sample size. When the auditor testing the items of client, it's better to do physical observation based on the total number of hours rather than number of inventory items counted, so the auditor will easily specify the items for testing. The last, selection of items. When auditor observe the client counting inventory, they should be careful to first observe the counting of most significant items and representative sample of typical inventory item. Second, inquiry about items that are likely to be obsolete or damaged. Third, discuss with management the reason for excluding any material items. Next, physical observation tests. The most important part of the observation of inventory is determining whether the physical count is being taken in accordance with the client's instruction. Next learning objective is about audit of pricing and compilation. Inventory price tests. For inventory price tests include first one, pricing and compilation controls. Adequate internal controls surrounding the tracking of unit costs that are integrated with production and other accounting records provide assurance that clients use a reasonable cost for valuing ending inventory. Standard cost records that indicate variances in material, labor, and overhead costs are helpful to evaluate the reasonableness of production record if management has procedures in place to keep the standard updated. For changes in production process and cost, management should also have the pricing and compilation control. Second, pricing and compilation procedures. Auditors can apply the objective using information obtained from the client as a frame of reference, including each inventory items, description, quantity, unit price, and extended value. We assume the information reflected in the inventory perpetual listing is recorded in inventory item description order with raw material, work in process, and finished goods listed separately. The listing totals should equal the general ledger balance. The last inventory price test is valuation of inventory. There are three concerns for valuation of inventory. First one, pricing purchase inventory. The primary types of inventory included in the category raw materials, purchase parts, and supplies. As a first step in verifying the valuation of purchase inventory, the auditor must determine whether the clients use LIFO, FIFO, weighted average, or some other valuation method. Auditor must also determine which costs should be included in the valuation of an item of inventory. Second, pricing manufactured inventory. In pricing work in process and finished goods, the auditor must consider the cost of raw materials, direct labor, and manufacturing overhead. And the last valuation of inventory is cost or market. In pricing inventory, auditors must consider whether market value is lower than historical cost. The determination of market value or replacement cost or net realizable value depends on the costing method used. The last is about balance-related audit objective. There are 7 balance-related audit objectives. First one is existence, means inventory as recorded on tax access. Second, completeness, means existing inventory is counted or tagged. Third one, accuracy, inventory is counted accurately. The fourth one is classification, means inventory is classified correctly on the tax. The fifth, cutoff, transactions are recorded in the proper period. The sixth, realizable value, obsolete and unusable inventory items are excluded or noted. And the last is rights. The client has rights to inventory recorded on tax. The next learning objective will be presented by Ananda.
Okay, the last, the integration of the test. Next. Next, okay. First, test of the acquisition and payment cycle. When the auditors verify inventory acquisition as part of the test of the acquisition and payment cycle, they are also obtain evidence about the accuracy of raw materials acquired and all manufacturing overhead costs incurred except labor. This acquisition costs either flow directly into cost of goods sold or become the largest part of the ending inventory of raw material, work in process, and finished goods. Second, test of the payroll and the personnel cycle. When auditors verify labor costs, the same condition apply as for the acquisition. Third, test of the sales and collection cycle. Most of the audit testing in the storage of finished good, as well as the shipment and recording of sales take place when the sales and collection cycle is tested. When the client use standard cost records, auditor may be able to test the standard cost of goods sold at the same time that sales tests are performed. Fourth, test of cost accounting. To verify the control affecting inventory that auditors didn't verify as part of the testing in the preceding 3 cycle. And the last, physical inventory pricing and compilation. In testing physical inventory, auditors may rely heavily on the perpetual inventory master file if they have been tested as a part of one or more of the cycle and are considered reliable. When the testing the unit cost, auditors may also rely to some degree on the test of the cost record adhering to the substantive test of the transaction. As auditors test control and perform substantive tests related to inventory transaction and balance, they also integrate tests related to balance-related audit objective with the test performed to satisfy the 4 presentation and disclosure objective. Next. Interrelationship of the various audit tests. For the inventory test, there are 3 tests: test of the cost accounting record, test of the physical inventory observation, and the test of the pricing and compilation. For the test of the acquisition and payment cycle, for the raw material, for the formula is beginning inventory plus acquisition of the raw material minus ending inventory equal to raw material used. Test of the payroll and personnel cycle, work in process. For the formula, beginning inventory plus direct labor plus raw material use plus indirect labor and other manufacturing overhead minus ending inventory equal to cost of goods manufactured. And for the test of the sales and collection cycle, for the formula of finished good, beginning inventory plus cost of goods manufactured minus ending inventory equal to cost of goods sold. Next.
Okay, that's all from our group. Sorry if there are mistakes and thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh.